What's up, streaming lovers? So 1 year ago, I posted a video on why I was buying Netflix stock, and I thought that the market was wrong on it. Since then, the stock is up 100%. Today, I want to discuss whether I think a similar opportunity exists today. We'll look at their recent earnings report and the state of the overall streaming wars. So Netflix just reported their earnings this past week, and once again, the stock sold off brutally. It was down 10% right after the earnings. Tesla also saw a massive dip. They reported earnings the day before, despite what I thought was an excellent report. You can watch my last video if you're interested in Tesla. So today I want to briefly discuss my thoughts on Netflix earnings, the state of the streaming wars, and whether I see a similar opportunity this time around. So if we look at the earnings report, Netflix has been attempting to crack down on this password sharing. That was one of a few ways they outlined a growth path when I made the video a year ago. So it looks like they're starting to make progress there. They launched paid sharing in 100 plus countries this past May. Now, despite some initial outrage, how dare Netflix expect people to actually pay for their service? It seems to be moving along well. Signups are exceeding cancellations, which, that may come as a surprise, but the people who are not paying had nothing to cancel. So they had 5.9 million net additions in Q2. Q2 revenue, $8.2 billion with $1.8 billion of operating profit. And they're expecting revenue growth to accelerate in the second half of 2023 as paid sharing and their new ad-supported plan tier continues to grow. Now, I thought it was really interesting in an ever-growing sea of entertainment options, it seems. Netflix had the top original streaming series in the USA for 24 of the first 25 weeks of 2023, and the top movie for 21 weeks. So it appears they're doing something right. They continue to set themselves apart in this crowded playing field of streaming options. Netflix has taken this something for everyone approach, and they owe part of their success to their wide-ranging, library of content. The way I see it with Netflix is that they're fighting a war on two fronts here. The first front, which I think was outlined perfectly in the earnings report, is with the more traditional streamers. So if we just hear some quotes from the report, consumers have so many amazing entertainment choices, from movies and TV shows to sports and news to gaming and social media, just to name a few. We expect the competition will remain intense, including within streaming. Our biggest traditional entertainment competitors, Disney, Comcast, Paramount, and Warner Bros., with their large content libraries and creative expertise, are now focused on profits so they can build sustainable long-term streaming businesses. Our big tech competitors, Apple, Amazon, and YouTube, with their broad reach and deep pockets, continue to invest heavily to grow their streaming revenues. And last but not least, Netflix revenue was $32 billion in 2022, compared to nearly $40 billion of revenue for YouTube across all its products, which YouTube I throw in this second basket of the second front. We'll get to in a minute. But if we just look at the traditional players here, this is a very crowded arena. And I think it is a good sign, though, when we look at the share of US TV screen time from 2021 to 2023, Netflix has actually increased their share. They went from 6% to 8.2%. So again, excluding YouTube, if we just look at the traditional kind of streamers here, they are in the lead by a wide margin. And I think you've got plenty of runway for growth because, as we can see, 60% of this market is still broadcast, cable, and other. So all that is going to continue to climb, as we saw from 2021 to 2023, and there's going to be a big void to fill there. Now, I think we've kind of seen this already, but these legacy media companies that have not made the jump to streaming, they're dead on arrival at this point. It's just too late, and I can't see those that were late to the party finding much success, so I think it's inevitable that they're going to capitulate, they're going to get acquired, or agree to license their content to a major streamer like Netflix eventually. This might take a few more years to fully play out, but Netflix continues to grow its library of original content, and it's becoming increasingly popular. Now, if we look at something like Disney here, who has 2% of the US screen time, despite their best efforts to self-sabotage lately, they've been ostracizing 50% of the population. I think they're eventually going to overcome their woes. It's pretty hard to go wrong when you're a cultural icon that also owns Marvel and Star Wars. The mouse will always find a way to secure the money bag. Now, as they mentioned in the report, Amazon, Apple, these are companies with very deep pockets, but it will be a challenge to compete with them, but it's not impossible. And I kind of see the next decade as maybe you have a Netflix, Disney, HBO, Max, they renamed it to, not sure why, Prime Video, and maybe Apple TV, 5 streamers, maybe plus or minus a couple more, all being able to grow and thrive simultaneously. I mean, for the last 20 years, we had like 300 cable channels that all managed to succeed. So I think 5 streamers should be able to, maintain meaningful portions of the market. Again, as we see there's still so much runway for growth with traditional cable as it continues to wind down. So maybe there's a couple I missed there. I mean, those are kind of like the top 5 that come to my mind. But let us know in the comments below which streaming services you use the most or think deserve an honorable mention. So that's the first front. And I think that one is the more manageable. Netflix has a good position in that market. They are the leader. We'll look at the subscriber numbers in a second here. But I think that they can, at worst, they all, let's say, become 20% of this market, and there's plenty of room for them all to thrive. But right now, Netflix is the leader. The second front, and this is the more concerning area for me, we look at something like YouTube. I throw that in this category. Completely different animal, right? Netflix brought in $32 billion in revenue for 2022 compared with YouTube's $40 billion. YouTube just has better unit economics. They don't have to produce all these expensive shows. The creators are. Here we are on YouTube. Modern entertainment is ever changing, and it's not really constrained by these same traditional rules. Now, not to mention the likes of TikTok, Reels, obviously YouTube Shorts, even Twitter seems poised to move into this video space. You look at something like Tucker Carlson going on Twitter, getting hundreds of millions of views on his videos now. I think it's only a matter of time before many more media personalities from both sides go independent, find their way to Twitter. So there's a lot of competition for people's attention every day, and these other, newer forms of entertainment are just growing and going to increase their share of the market. So, while I think something like TikTok is a complete cancer to society and has forced others to move to this short-form content idea in this attention span race to the bottom, there's no denying that these things are taking up more and more of people's time every day. I mean, who knows if people will have the attention span to watch a 2-hour movie or a 30-minute show in 10 years. I hope for the sake of our collective IQ that is not the future, but there's no denying that short-form content is expanding, and it's going to come at the expense of watching more of these traditional longer-form content programs. So this is kind of a wild card that's hard to predict, but it just doesn't seem to bode well in any way for Netflix, unless they were to break into that space, which they haven't yet. So again, very crowded space of traditional streamers. That's their first front that they're fighting on. And number 2 is just people's overall attention as entertainment and media shifts to these different newer forms and shorter form content. Now, if we look at the rankings from a subscriber perspective, Netflix is in the lead by far. So Netflix is coming in at around 238 million subs. Prime Video, which remember is the entire Amazon Prime bundle. So kind of unfair to compare, but it is what it is. These bundles really give these companies like Amazon an advantage. But so they're at 200 million plus. Disney's at 158 million, give or take. Now, granted, it's interesting. The last couple quarters, Disney subscribers have actually declined, and they are kind of struggling, which I think is all short term. I think they'll figure it out. HBO Max just under 100 million, Paramount 60 million, Apple TV Plus, it's estimated has around 25 million, and then Peacock 21 million. So again, here's some of the top names. I think it's realistic that they can coexist and all continue to grow again at the expense of that declining cable market share. But let me know what you guys think. I am just really curious. What do people use the most? What do you think is being slept on? So now let's move to the outlook for Netflix. So they're anticipating at least $5 billion in free cash flow for 2023. Up from their prior estimate of $3.5 billion. Their updated expectation reflects lower cash content spend in 2023 than originally anticipated due to timing of production starts and these ongoing strikes. While this may create some lumpiness in free cash flow for 2023 to 2024, we plan to deliver substantial positive free cash flow in 2024. So it seems like things are looking up in 2023 and maybe the latter half, and 2024 should be better for this company. And we'll take a look at their growth rate in a second here. But over a longer time horizon, what is the bull case for Netflix? Is it going to be that they get into gaming? Is it just this household staple that has a huge first mover advantage? I believe Netflix has a recipe that works, and it's in large part thanks to their data-driven approach. Their personalization, their recommendation algorithms are best in class. It's a discovery engine. It's funneling these titles that would not have seen the light of day at a traditional media outlet. They're getting those titles to the right audience, and people are finding this stuff is interesting to them. The content is tailored to users' interests. It's a very personalized experience. And then Netflix is very good at, they've got all of this data they're able to use. You know, what's your watch history, preferences, your viewing patterns, and they can use this data to make informed decisions about what new content that they should invest in. So while I think all that's great, I don't think it's a strong enough moat, as I think others are going to figure this out too. So I think long term, their success is really going to rely on their ability to produce their own franchise IP with a strong value proposition. I mean, they've succeeded so far, as evidenced by some of these major titles you can see here. But it's also interesting, you know, when new seasons or sequels to their original shows come out, kind of reignites this interest in the older releases of the series, and then the whole thing goes viral again. So Netflix has amassed a huge content library, and their strategy, I think, worth noting, has found international success, which is something many of their peers have struggled to achieve. You know, traditionally, U.S. media has kind of taken this what's popular in the US and then trying to push it out to the rest of the world. Whereas Netflix has taken this approach where they make these regional, you know, hits. Think of a Squid Game that ends up being very popular in international region, but also popular back home in the US as people discover, you know, they love something that they never thought they even would watch. So I think it's only a matter of time until a lot of these legacy media outlets go bust or are bought out. I think many of the other traditional media companies that are attempting to break into streaming, they're unprofitable. They can't seem to manage the convergence of media and technology. You know, most of them are just traditional media companies. And you really have to be both a media and a technology company to succeed in the modern streaming wars. So I think that all bodes well for Netflix. Now, if we look at their growth, they really are not growing much here. Very modest single-digit growth. I mean, over the last few quarters, as you can see, they're growing very little. Q4 2022, only 1.9%. Q1 23, 3.7%, Q2 2023, 2.7%. Now they're projecting Q3 revenue growth of 7.5%, so a little bit better, but still, you know, very modest growth. Nothing crazy, not double digits like it used to be. So 1 year ago when I made that video and why Netflix, you know, why I was really excited about Netflix, their growth rate was more like 20% still. So the growth rate has massively declined, and you can kind of get an idea for that as well here when we look at their year-over-year quarterly growth at the bottom. You know, the growth is just not where it used to be. And, you know, their growth has slowed quite a bit, but they are still in the lead for paid membership. They're still growing, even modestly, while others like Disney are seeing their subscribers decline. So when I posted my original video a year ago, their growth rate was much higher, around 20%. With their low single-digit growth now, it's not a name I want to be in, as I don't see enough. I don't see a good enough risk-to-reward ratio. You know, now having said that, Netflix currently has arguably the widest range of content among the streaming companies, and I have no doubt they will continue to be the industry leader. There's something for everyone there. They're finding international success. Their personalization and recommendation algorithms are great. You know, accompanied with an ever-increasing library, they should retain current customers and maintain their modest growth. I think they're going to do well relative to their peers, and it's worth following along just because, you know, I just find this as an interesting industry case study here. But a company posting low single-digit growth for 4 straight quarters is not a screaming buy to me. It's going to take a new engine for growth to be worthwhile, and there just doesn't appear to be one right now. So unless there's a big industry shakeup where competitors capitulate or Netflix brings forth something revolutionary, you know, a new growth avenue, it just doesn't seem to be a tremendous opportunity currently to me. So let me know what you guys think in the comments below. If you enjoyed the video, don't forget to like and subscribe. You can also check out my Substack in the description below, where I also wrote an article on Netflix. I'll see you guys in the next one.